All right, let's get right into it. Today, we're going on a bit of a hunt. But we're not looking for the next multi-bagger stock. No, we're looking for the red flags, the clues that can save you from the next big corporate collapse. We're going to learn how to read an income statement, not just like an investor, but like a financial detective.
And that really gets to the heart of it, doesn't it? The truth is so often hiding in plain sight, right there in the numbers, long before any of the bad news hits the headlines. The warning signs are almost always there, but, most people just don't know where to look.
I mean, look at these names. These aren't just stories from business history. These were absolute wealth destroyers. And every single one of them, they left a trail of crumbs in their financial statements. Clues like fake revenue and hidden costs that we are going to learn how to spot.
So where do we start our investigation? Well, it starts right here, with the income statement. And why there? Because most financial frauds, they don't begin with some super complex balance sheet trick. They start with a really simple goal: to fake profits.
What's so fascinating is the difference in focus. The average investor gets totally caught up in the story, right? The share price, the news, what the CEO is saying in interviews. But a smart, skeptical investor? They start with the source code, the financial statements. They're focused on the quality of the numbers, not the hype.
And look, who are we to argue with the father of value investing himself, Benjamin Graham? He knew that earnings, that famous bottom line, is actually the easiest number for a company to manipulate. And that is exactly why we start our investigation right here.
Okay, our first red flag is the biggest one of all: deceptive revenue. This is where companies create this illusion of incredible growth by booking sales that, they aren't real, they can't be collected, or in some cases are just completely made up. So let's follow the money trail. This is probably the single most important question you can ask when you look at that top line of the income statement. Don't just take it at face value. You have to challenge it. Is that money actually really hitting the company's bank account?
And here's exactly how you challenge it. You look for these warning signs. The most telling sign, by far, is when you see revenue just soaring, but the cash from operations is flat. It's going nowhere. That's a huge alarm bell. It means they're booking sales, but the cash just isn't coming in. A classic trick here is something called channel stuffing, where a company basically forces its distributors to buy way more product than they can actually sell, just to pump up the numbers for a quarter. Mampassan Beverages was accused of doing exactly this, which led to a massive stock collapse when the truth finally surfaced.
And this chart, it shows you the problem perfectly. When you see a picture like this, these high bars for revenue growth, but a flat or even declining line for cash flow, a siren should be going off in your head. It's a massive disconnect. Sales on paper are totally meaningless without cold, hard cash to back them up.
The expert on this stuff, Howard Shillett, he puts it perfectly. If you can spot fake revenue, you can avoid some of the absolute biggest disasters in the stock market. It really is the original sin of accounting fraud.
Okay, let's move on to clue number 2. Let's say the revenue seems legit. The very next place to hunt for trouble is in the profit margins. This is where companies try to convince you they have some kind of magical business that just defies the laws of economics. As a financial detective, you have to be deeply suspicious of perfection. If a company is in a really tough, cyclical industry, but somehow their profit margins are always high and perfectly stable, you have to ask yourself, how are they doing that when all their competitors are struggling? So here are the signs. Look for margins that are actually getting better when the entire industry is in a downturn. Or take the PC Jeweler case. Here was a company that was reporting perfectly stable profits even when its main raw material, gold, had prices that were swinging all over the place. For analysts, this raised huge red flags because it just didn't make logical sense, and it contributed to a huge drop in the stock. And also, keep a sharp eye out for other income. That's when a company sells off an asset just to pump up its net profit and distract you from a weak core business.
The legendary investor Peter Lynch gave us this fantastic rule of thumb. Perfection is not normal in business. It's often a sign that the numbers are being managed or smoothed out to tell a story that is just too good to be true.
All right, so we've checked for fake revenue and we've questioned unbelievable profits. Our third and final area of investigation is what I like to call the dark art of making expenses vanish. See, if you can't inflate your revenue, you can still boost your profits by just pretending your costs are lower than they actually are. It's such a simple question, but it's incredibly powerful. When you're looking at that income statement, just ask yourself, does this make sense?
If a company's sales have doubled, where are the matching increases in costs that you'd expect to see to support all that growth?
The clues are right there if you look. Employee costs that stay flat for years while the company is claiming explosive growth, a tax rate that's always near zero with no good explanation, and my personal favorite, the endless parade of adjusted profits, where a company basically asks you to please ignore all the bad stuff and just look at this other number we made up.
And this brings us to probably one of the most infamous examples ever. WeWork invented a metric they called community-adjusted EBITDA. And in simple terms, it was basically profit before all the costs. It was a completely meaningless number designed to hide billions of dollars in losses. It's just a perfect example of how absurd these adjustments can get.
And that's the lesson here, summed up beautifully by Jack Schwager. When a company starts inventing its own metrics just to look good, they are handing you a giant, waving red flag. A good investor trusts the real numbers, not the made-up story.
All right, we've covered the three major crime scenes: revenue, profits, and costs. Now let's pull all of this together into a really simple, actionable checklist you can use on any company. Think of this as your forensic toolkit.
So let's walk through it one by one. First, compare that revenue growth to the cash flow. Is the cash really coming in the door? Then, number 2, check if receivables, those IOUs from customers, are growing way faster than sales. Next, question those perfect margins. Are they really sustainable or just too good to be true? Then, look at other income. Is a one-time asset sale propping up the whole thing? Number 5, are they paying a reasonable amount of tax or is it suspiciously low? And finally, number 6, make sure the expenses look realistic and are actually growing in line with the business. It's a simple, repeatable process.
And here's the most important part. You don't need to find definitive proof of fraud. As a retail investor, your job is just to manage your risk. So if you run a company through this checklist and you find 3 or more of these red flags, the answer is simple. Just walk away. There are thousands of other companies out there to invest in.
We'll end with another gem from Benjamin Graham. Always remember, reading the annual report isn't the end of your work. It's the very beginning. It's where your real investigation starts. So stay curious and always stay skeptical.
And this right here is the ultimate takeaway. Before you even start thinking about how to make money, you have to focus on how not to lose it. Learning to spot these red flags, it isn't about being cynical. It's about being smart and protecting your hard-earned capital. Because in investing, the best offense is always a great defense.